Hello again from me, Louis Rossouw. I'm a portfolio manager at Adviceworx Private Client Securities, and I'd like to spend the next 10 minutes or so sharing ideas with you. I will discuss the COVID-19 pandemic and its impact on the global economy and investment markets. I will also explain how Adviceworx interprets the current investment climate and share our view on prospects for the rest of the year. The past month saw a series of extreme weather phenomena play out all over the world. As average global temperatures rise, the dry parts of the globe become drier and hotter, while temperate regions are experiencing abnormally heavy rainfall. The Pacific Northwest of the United States and Canada was ravaged by record high temperatures and immense wildfires, while Germany, Belgium, Bangladesh, and China suffered some of the worst flooding in living memory. 15 million new COVID infections were reported in July, bringing the total for the world to 198 million. 220,000 people succumbed to the disease, which brings the total death toll to date to 4.2 million. The United States remains hardest hit, with nearly 36 million infections and nearly 630,000 deaths. India, Brazil, Russia, and France still make up the rest of the top five, and South Africa remains in 17th position in terms of the most recorded COVID cases. As of the 31st of July, 2.3 billion people, or 28.5% of the world's population, had received at least one dose of COVID vaccine. 4.1 billion doses of vaccine had been administered, and nearly 40 million doses were being administered per day. China is leading the way with more than 1.6 billion doses already administered, followed by India with 456 million and the United States with 344 million. 1.14 billion people, or 14.7% of the world's population, can now be regarded as fully vaccinated. Although China does not provide this metric, it is estimated that about 770 million Chinese are fully vaccinated by now. July was a tough month for global equity markets, with most major indices flat or negative for the month. Thanks to a strong contribution by resource shares, the JSE's Top 40 index was the month's top performer, while mainland China's A50 and Hong Kong's Hang Seng brought up the rear. For the year to date, the CAC 40 in Paris is back in the lead, with China and Japan lagging. Over 1 year, the Russell 2000 is at the top and the A50 at the bottom of the rankings, and over 3 years, the Nasdaq and Hang Seng, respectively. Commodities fared significantly better than equities in July, with coal, steel, and lithium delivering strong double-digit performances. Gold ended barely positive, while oil and uranium ended flat for the month. For the year to date, lithium, coal, and tin are ahead of the pack, with precious metals bringing up the rear. Let us talk about the economic and investment outlook for the third quarter of 2021 now. The global economic recovery continues, but the continued evolution of new COVID variants threaten to derail it. Vaccination proceeds apace in the developed world, but its rollout is uneven in the third world. The US economy is booming to such an extent that inflation is becoming a problem. It is unclear at this stage whether higher inflation is a temporary or more persistent problem. If inflation is in fact here to stay, it will lead to higher interest rates and economic slowdown. The inflation conundrum poses a challenge to central bankers. Premature monetary tightening will dampen the economic recovery, while inaction could cause inflation to become systemic. Judging by the recent drop in bond yields, the market is expecting global growth to slow down in the coming months. This decline in yields provides support to the equity market, which has been becalmed of late. The prospect of rising US interest rates has resulted in a firmer US dollar and capital is once again flowing back into US markets. The Adviceworx global asset allocation view has not changed materially since our last update 3 months ago. We remain positive about global equities, but are concerned about the exceptionally high valuations on Wall Street. European and emerging markets offer far better value. We remain neutral about listed property, since some sectors like data and logistics are robust, while others like retail, offices and hospitality are likely to battle for some time to come. We remain skeptical about global bonds and cash, since the yields they offer are very low and often negative in real terms. We are also concerned that higher inflation could result in rising interest rates, which will lead to capital losses on the bond market. In cases where we are mandated to invest in fixed income, we prefer emerging market bonds to those of developed markets. Locally, the news headlines were dominated by the unrest and looting in KwaZulu-Natal and Gauteng, which seemed to have been instigated by supporters of the jailed ex-president Jacob Zuma. Billions of rands worth of damage was caused, mainly to shopping centers and warehouses, and the country's supply chains were disrupted. More than 300 people lost their lives, and thousands more were arrested on charges ranging from looting to public violence. The third COVID wave hit South Africa in July, with 430,000 new cases being recorded and nearly 11,000 new fatalities. Nearly 2.5 million South Africans have thus far tested positive for the coronavirus, and more than 72,000 people have succumbed to the disease. The recent unrest will no doubt have resulted in numerous super spreader events, but at least South Africa's vaccination program is starting to accelerate, with well over 200,000 people now being vaccinated every weekday. The JSE was among the world's best performing equity markets in July, mainly thanks to a sharp rise in some resource shares. Naspers and Prosus had a torrid month due to the Chinese government's continued crackdown on big technology companies, including Tencent. The weaker rand benefited rand-hedged stocks, but there is concern over some resource shares, particularly platinum group metal producers. Retailers are posting good results, but financials remain under pressure. The bond market suffered short-lived unrest-related jitters, while the rand also seesawed. We remain concerned about the local economy's slow recovery, which has been hampered by lockdowns, the slow start to government's vaccination program, and renewed load shedding. The unrest in KwaZulu-Natal and Gauteng, followed by the cyber attacks on Transnet, added insult to injury. The OECD expects our GDP to only get back to its pre-pandemic levels in 2025, but at least inflation remains under control for now. Petrol and diesel prices will rise sharply in August, but at least Medupi is now operational. The commodity export boom will boost government's tax revenue, and South African Airways will henceforth hopefully be less of a drain on the fiscus. Despite some positive economic developments and strong global tailwinds, we remain cautious about the prospects for the local equity market. Company earnings have improved after last year's crash, but the weak local economy, uncertainty over government's economic policy intentions, and the prospect of renewed unrest have led us to retain our slightly underweight position vis-à-vis local equities. We remain negative about South African listed property, since the operating environment is largely negative. South African nominal bonds remain our preferred domestic asset class. We are mindful of our country's fragile fiscal position, but believe that bond yields have priced in a sufficiently large risk premium. We are cautious about corporate credit and favor inflation-linked bonds on the short end of the yield curve and long nominal government bonds for the longer term. The Adviceworx asset allocation view can be summarized as follows. We remain overweight global equities because of the greater opportunity set they offer and our long-term concerns over the structural vulnerability of the rand. We are gradually adding to our local equity allocation and remain neutral on global property. We still avoid local property because of the uncertainty over the long-term health of the sector and hold no global bonds unless specifically mandated to do so. We are also maintaining our tactical overweight position in local bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make at least some sense of it. Should you have any further queries or questions, please don't hesitate to contact me or your Adviceworx financial advisor. All the best for the week ahead. Goodbye from me.